Hi, so in this YouTube discussion, we'll discuss different scenarios in shipments at build price, wherein there's combinations of purchases from outside suppliers, shipments coming from home office, or different markups between periods from shipments coming from home office, and of course ways to solve that. So among those scenarios, the common ones I have seen in problems, we have the following. Okay. So we have markup on the beginning inventory and on all shipments from home office are the same, meaning there's uniform markup from last year up to the current year. I'm using as my reference the markup coming from last year because the items in our beginning inventory comes from the shipments from last year. So those items which were not sold last year will go in our beginning inventory. So assuming that the markup across periods are the same, or at least the previous and the current period are the same, and no purchases from outside suppliers, we'll have number one. Case number two, or scenario number two, the markup on begin inventory on all shipments from home office are the same, but there are purchases from outside suppliers. So the resources of the branch comes from the home office and at the same time from outside suppliers. And number three, there are different markup on shipments from the previous year and the current year, but no purchases from outside suppliers. And lastly, you have different markup from period to period. Then there are purchases by the branch from outside suppliers. So for number one, we start with markup on the beginning inventory on all shipments from the home office are the same. No purchases from outside suppliers. Method number one. You have the following information: beginning inventory. Cost is 100,000, 50% markup above cost. So that's 100,000 times 50%. That means the markup is 50,000. So you add 50,000 in 100,000, you get a build price of 150,000. Be careful of the phrasing because sometimes problems may say 150% of cost. Okay, 150% of cost. So how to compute for the build price in that case? That's 100,000 cost times 1.5 because 150% of cost. Okay. In this case, 50% markup above cost. So you get 50% of this and then you add it on top of the cost. So same thing for shipments. You have sales, you have ending inventory and expenses. So method number one. Compute the branch income, then add the realized markup. So let's start with scenario number one. Starting with the first method, we have our sales at 700,000. Our cost of goods sold computed as follows, starting with beginning inventory at build price, which amounts to 150,000, plus the shipments from home office, amounting to 300,000 at build price, less ending inventory at build price amounting to 75,000. That gives us our cost of goods sold. You have 375,000. So we have our gross profit 325,000, and then we deduct expenses 25,000. So we have our net income at 300,000. So for the first method, we just have to compute the net income of the branch as we normally do, and then we add the realized portion of the overvaluation or the realized portion of the markup. So our beginning inventory here has a markup of 50% above cost. So this is how you compute for the markup. So say for example, you have build price, you have the cost, then you have the markup. So in our case, for our beginning inventory, the build price is 150,000. Okay. And then according to the problem, there's a markup of 50%. So the markup is 50% above cost or based on cost. That means our cost is 100%. So how do we get the percentage for the build price? We add 50% plus 100%, we get 150%. Okay. So how do we compute for the cost? Simple, we just divide 150,000 divided by 1.5, we get 100,000. From there, we can compute for the markup. That's 150 minus 100,000, we get 50,000, or simply 100,000 times 50%. Take note, our 100% is the cost because the problem states 50% based on cost or 50% above cost. So this is the formula we will do in order to compute for the markup. So we already have the markup for the beginning inventory. Okay, so beginning balance of allowance for overvaluation or markup, that is 50,000. Then we do the same for the shipment. So for shipment, we have 300,000. 300,000 divided by 1.5, you get 200,000. That means the markup is 100,000. Okay. So plus overvaluation, allowance for overvaluation from shipments. Okay. Amounting to, that's 100,000 less the ending allowance for overvaluation. So our ending inventory is presented at build price. Same process, 75,000 divided by 1.5, we get 50,000. So 75,000 build price, cost is 50,000. That will give the our markup 25,000. So we deduct 25,000 because it still remains in the ending inventory. It has not been realized yet because the inventory has not been sold yet. So the realized portion of the markup or overvaluation is, you get 125,000. Now how do we get the branch through net income? We just add 300,000 plus 125,000, which will give us 425,000. Okay. Now we go to method number 2. Okay. We go to method number 2. For method number 2, bring all inventories to cost and then compute branch income. Under method number 2, we only have to present all inventories or shipments coming from home office at its cost. Okay, so we present the figures already in cost. So 700,000 beginning inventory, it's given in the problem, but if you don't know how to if it is not given in the problem, you can just follow what we did before, like 150,000 divided by 1.5. So in this case, 150,000 divided by 1.5, beginning inventory is 100,000. Shipments from home office, same process. We get 200,000. Ending inventory, same thing, 75,000. That's 150%. So you divide 75,000 by 1.5, you get 50,000 as for the cost. Okay. Of course, the difference is the markup. So less 50,000, you have cost of goods sold amounting to 250,000. So sales minus cost of goods sold, we get our gross profit. 450 less expenses amounting to 25,000.
we have our net income 425,000, which is basically the same as with the method number 1.
Method number 3. Compute the cost of goods sold at build price, then convert the cost of goods sold into cost. Use the same in computing the branch net income. Take note, however, method number 3 only works if the markup percentage is uniform and there are no purchases from outside suppliers.
Okay, so as for the third method, and this method is only applicable in scenario number 1, wherein the branch only gets its inventory from the home office and the branch doesn't have any purchases. Yeah, it follows, of course. And of course, by the way, again, so the branch only gets its inventory from the home office, and there's common or uniform percentage markup among all shipments. So we will have this. So for method number 3, you have sales minus cost of goods sold. That gives us our gross profit minus expenses. We have our net income. Okay, so first we go to cost of goods sold. So we start with beginning inventory plus shipments from home office less ending inventory. So beginning inventory at build price was 150,000, shipment was 300,000, and ending inventory was 75,000. Okay, so that will give us our cost of goods sold. At 375,000. Now take note, this cost of goods sold at 375,000 is at build price. Okay, so what about the cost? The same formula will follow. Okay, so 375, this is you have 50% markup based on cost. So it's based on cost, that means our cost is 100%. And of course, this is less in order to work back or to compute for the missing percentage here. We get 150%. So how much is the cost or the actual cost of our cost of goods sold? 375,000 divided by 1.5. We get 250,000. Okay. So of course, the difference between both 375 to 50, this is your realized markup. Okay, realized markup. So we are going to use this here, 250. So 700 minus 250, you get 450 minus 25,000 expenses, we get 425,000. Okay.
Now in scenario number 2, you have the markup on the beginning inventory and on all shipments from the home office are the same, but there are purchases by the branch from outside suppliers. So we still have the same information, however, we added a new one. You have purchases amounting to 100,000. So compute the branch income, then add a realized markup, method number 1.
Now in scenario number 2, we have the same facts, we have the same information. The only thing that was added is that there's an additional purchase from outside suppliers of 100,000. So for the first method, same process. We get the net income, then we add the realized portion of the markup. So we still have sales amounting to 700,000. And then we have cost of goods sold, starting with beginning inventory amounting to 150. Okay, at build price. Shipments from home office amounting to 300,000. Purchases amounting to 100,000 less ending inventory amounting to 75,000. gives us our cost of goods sold, 475,000. So we have 225,000 for the gross profit, less expenses of 25,000. We get the net income reported by the branch at 200,000. Okay, so this is the net income reported by the branch. So what about the branch true net income? Okay, or so the realized portion of the allowance for markup. So we have beginning balance of allowance for overvaluation, which is the markup on the beginning inventory of the shipment, which is 50,000, plus the markup on the shipment from home office allowance for overvaluation, which amounts to 100,000, less the markup on the ending inventory. So we have less ending inventory allowance for overvaluation, 25,000. Again, in computing this amount, you can just use the same formula. You have build price minus cost is equal to your markup. Okay. For example, we have 75,000 for ending inventory, and according to the problem, that's 50% above cost. That means this is 150%. 75,000 divided by 1.5, we get 50,000. To get a markup, we get 25,000. Okay? So, the realized portion of the markup is now 125,000. Realized markup 125,000. We add it with our current net income. We get a total net income of 325,000. That's method number 1.
Method number 2.
Method number 2. So for method number 2, we only have to bring all shipments to its cost, all inventories to its cost. So beginning inventory cost is 100,000. Yeah. Okay. Same formula there. Shipments from home office is 200,000. Purchases, take note. Remember, you don't have to apply the one we did cut and divide into 1.5 because you don't apply this one for purchases. Why? Because purchases is inventory coming from outside suppliers, and those inventories are already at cost. Okay, as compared to the shipments coming from home office, which are at billed price. That's why you still have to bring it to its cost. But for purchases, it is already at its cost, so you don't have to apply this. So we have 100,000, ending inventory 75,000. And so you have 100 plus 200 plus 100 minus 75, 325 for your cost of goods sold. Gross profit 375, less expenses of 25,000, we get 375 minus 25,000, you get 350,000. Was it the same? Oh, sorry, there's a mistake. So this should not be 75,000. Instead, because we're talking about cost, the cost of this 75,000 is 50,000. That was my mistake. Okay, so 100 plus 200 plus 100 minus 50,000, we get 350,000. I'm sorry. So 700 minus 350, we get our gross profit 350 less 25,000. We have net income, true net income 325,000, which is the same using method number 1. So it's up to you which method you're comfortable with. And then lastly, we'll have case number 3. So for case number 3, again, going back or comparing case number 1 or scenario number 1 and scenario number 2, you will notice that in scenario number 1 we have 3 methods. In scenario number 2 we only have 2. That's because the third method in scenario number 1 is only applicable when there's no purchases outside from outside suppliers, and there's uniform markup on all shipments from home office.
So for third scenario, different markup on shipments, no purchases from outside suppliers. So if you will notice, beginning inventory is 100,000 and 100% markup above cost, meaning you have to multiply 100% times the cost. That is your markup. So the markup is 100,000 plus the cost. You get a build price of 200,000. And shipment from home office, 50% markup above cost. So if you will notice, you have different markup percentages. Method number 1, compute the branch income, then add the realized markup.
Now scenario number 3. For scenario number 3, okay, we don't have any purchases from outside suppliers, but the shipments are marked up at various percentages. So for example, in our case, you have the first or the beginning inventory, which is the shipment from last year, is billed at 100% above cost. Okay, 100% above cost. That means the gross or the markup is equal to the cost, so times 2. Okay, what the shipments this year is shipped 50% above cost, so times 1.5. Be careful of the phrases above cost or of cost. So for example, when you say 150% of cost, that means the build price is equal to cost times 1.5. It is different if it is 150% above cost, because that would mean you have the cost plus 150%. Okay, so take note of the difference of the phrases. So in our case, the shipment was billed 100% above cost, so times 2 last year. Of course, the remaining inventories last year would go to our beginning inventory this year, while the shipments this year is billed at 50% above cost. Now, how do we solve for this? Okay, so we have method number 1. So we start with our beginning inventory, which is beginning inventory, which is 200,000, shipments of 300,000, ending inventory of 75,000. So that would give our cost of goods sold 425,000, gross profit of 275,000, minus expenses of 25,000. We have our net income at 250,000. 250,000. Okay, and then for the realized portion of the markup, so we have our beginning balance of overvaluation. We have overvaluation of shipments from home office less ending balance of overvaluation. Now for the beginning balance of our overvaluation, okay, that's build price, you have cost, you have markup. Our build price is 200,000. The markup is 100% based on cost. So cost is also 100%. In order to get the percentage here, we get 200,000. So how do we get the cost? 200,000 divided by 200% or divided by 2, we have 100,000. So the markup is 100,000. As you can see, they're equal. So the markup is 100,000. We do the same for shipments and we will get 100,000 as well. Less for the ending inventory, we have 25,000, which is basically the same as in the previous scenario. So we have the realized markup. You have 100 plus 100 minus 25, you get 175,000. Then, right after you add this, 250 plus 175, that would give you 425, if I'm correct. 425,000. Okay? 425,000.
Method number 2, bring all inventories to cost, then compute for branch income.
Now, if we follow method number 2, we just have to bring all inventories at its cost. Bring all inventories at its cost. So using the formula we had earlier, we get the cost of the beginning inventory of 100,000. We have shipments of 200,000 and the cost for ending inventory is 50,000. So our cost of goods sold is 250,000. Our gross profit would now be 450 less 25,000 expenses. We get our net income at 425,000, which is the same as in method number 1.
For scenario number 4, okay, I'll leave this to you for you to answer. Different markup on shipments, their purchases by the branch from outside suppliers, and the answer will be given at the end of the video. And check your answer if it's correct. So you have beginning inventory, 100% markup above cost, plus you have the purchases. So you do method number 1 or method number 2 or both, that would be best. And lastly, you may pause the video so that you can answer it on yourself and then play it afterwards. And the answer is 325,000. That's it. Thank you.